Hello and welcome to the Summer Economic and Investment Update. I am Melissa Joy, so pleased to be joined by my colleagues Melissa Fradenburg and Hannah Near. And let's get this started. I'm going to share the screen. And again, it's us at Pearl Planning here on behalf of the whole team. Thrilled to be talking about where we're at in markets and life in summer of 2023. We are each financial advisors here at Pearl Planning, and today we are going to be talking about where we're at, especially just kind of a touch base on where markets, both stocks and bonds, have led us to so far this year. Melissa Fradenburg is going to share some economic updates, including things that are on everyone's mind. Is there a recession on the horizon? And talking a little bit about inflation. And then Hannah Near is going to dive deeper into the bond and stock market updates. And I will wrap things up with where to go from here, some actionable advice, some things that you should keep on your radar so that we can keep you on the right track with your money. So the S&P 500 is where we're going to start, and there's a lot going on in this image. What you can see is as of June 30th, you see that last line to the right, that green line is a significant upward trend. Through October of last year, markets were very gloomy, both stocks and bonds. It was a year that we will all likely remember, given that difficult times are often more memorable and painful than good times are less memorable, and exuberance doesn't last quite as long. But we've had a really strong recovery off of October 12th lows when it comes to the S&P 500. That has driven the kind of prices in the market higher. The price earnings ratio, which is kind of a measure of how expensive is the market, seems to be or is much higher, around 19 times than it was earlier in the year. But as we dive deeper into this conversation, you'll see that it is very narrow into growthier patches of the market. So there still are some areas that haven't quite caught up with the rest of the world when we look overall. But I do think it's worth noting, I was talking to clients as recently as April, May, and even early June who were just very gloomy, pessimistic, hadn't noticed that their accounts had been going higher since October. And hey, I agree, you are not at all-time highs quite yet if you were just invested in the S&P. In fact, those highs were at the very beginning of 2022. But gosh, we've made up a lot of room, up 24% when it comes to our most followed stock index, from the worst lows of October. And I think people really didn't start to notice that until more recently. So that's definitely worth noting. We always like to look at this chart. You'll see it time and again in our conversations because what it shows you is annualized returns, what happened every year going back to 1980. And you also see how bad it got during the year, because the story isn't just where that bar is at the end of the year, where it started and where it went. It's all the stuff that happens in the middle and in between. And those are the red dots. So that's how much the market pulled back during that time. So last year, like I said, was one for the books. Market down, as measured by the S&P 500, down 19%, and declined as much as 25% during the year. This year has been smoother sailing. We've had as much as an 8% pullback, but up 16% year to date through June 30th. And frankly, I don't think anyone saw that coming. There was a lot of pessimism going into the year. And that's one of the things that I'm going to note as we wrap things up. It is often the case that good things happen during pessimistic, very, glass half empty times. So it's worth remembering that these things are possible. And it's also worth noting that it is very difficult to predict what's going to happen in the market. But if you were to look at the bars going across since 1980, and it goes back even further, I'll show you a chart that goes back to the 1800s at the end. More often than not, the market goes up. It's about a 7 out of 10 batting average, batting 700. And there are some years that the market goes down too. Now let's talk about bonds for a second, because you had one of the most momentous, it was the biggest bond year, I would say, in my career last year. Interest rates went up, consecutively throughout the year and into this year, and they still have been rising. And what happened because of that was the biggest benchmark for bonds had just an awful year that we're still going to be talking about for quite a while. But what that did was reset the expectations for the bond market. And certainly there is the possibility of interest rates continuing to rise. And if you didn't notice it from the what I just mentioned, the down 13% last year, rising interest rates are very difficult for bonds in the short term. But they reset the forward-looking perspective of what we may get going forward. And this year, bonds have given us so far about what we would expect. They're yielding 4 to 5%, and they were up 2 year to date. Um, not without some volatility. So you can see that 4% decline in the interim, but coming out where they are returning again for investors' bond returns. So I think that's worth noting as well. So with that, I'm going to hand it off to Melissa Fradenburg. So we'll talk a little bit about the economy and tell you a little bit behind the scenes of what's going on and why all of the market returns are kind of happening interlinked with the economy. Melissa, over to you.
Thanks so much. And yes, as Melissa mentioned, she shared where the market is year to date. I'm going to share a little bit about where the economy is at. So if we look historically at this cycle, which began with COVID in 2020, we have had record amounts of fiscal stimulus, 5 trillion, in fact, which led to historically large deficits. The balance sheet, the Fed's balance sheet rose to about 9 trillion for the first time on record. Record job openings, we saw rise above 12 trillion. We had, even with the supply chain issues as a result of COVID, over this period, we have had a rise of about 20% in retail inventory since the start of COVID. And then service spending is extremely strong. So we've heard about last summer was the summer of revenge travel. Some economists are calling this the summer of revenge travel too. People are still spending on restaurants, travel, in fact, up 8% year over year. And what I want to point out is that while we've been hearing for at least 18 months about this recession that is coming, when we're looking at historical cycles in our economy, these things are not very typical of what we would see heading into a recession. So we do have to take into consideration not just how things played out over history, but also how our economy has evolved. So if we look at increase in national debt, so this is going back to February of 2020, we see that we have our debt has increased about 34% or 8.1 trillion, and that's a lot. Now, where did a lot of that go? That went into the pockets of consumers. So obviously that would help drive the economy. Now, we do forecast that government spending as a percent of GDP will be falling. And that is in large part due to the Fiscal Responsibility Act, which was put in place as part of the negotiations with the debt ceiling. So in fact, the government spending has to be reduced over the next 2 years. And if we look at monetary, keep going, thanks. So that is fiscal stimulus. Now, the other factor that we have to look at is monetary policy. So as Melissa mentioned, the Federal Reserve raised interest rates very dramatically. You see the line going up there between 2022 and 2023, back to the levels of 5%, which we haven't seen since 2007. Now, if you're like me, 2007 feels like yesterday because that helps me actually be in denial of my own age. But if we're looking at this chart, it is actually quite a long period of time that we had near zero interest rates, right? So on the next slide, we're going to look at how that affects the consumer and consumer spending. So if you have a credit card, if you have recently gone out to get a mortgage or an auto loan, you have felt this. But in fact, mortgage rates are the highest since 2001. And going back to February of 2020, the median mortgage payment was about $1,400, and today it is $2,700 a month. Auto loan payments, very similar, $688 a month back in February of 2020, and now just over $1,000 a month. So the money that consumers are spending on these things gives them less money left over for spending on other things. And so we are seeing that as the consumer is starting to cool down on spending. Now, I want to point out one thing here is that inflation has slowed for the last 11 months. But again, what the Federal Reserve was trying to do by raising interest rates is cool that economy, because we came out rather hot after reopening with COVID. So the good news, this is actually a good chart to look at, is that for the last 11 months straight, inflation has come down. So it is working. If we look at the next slide, again, inflationary pressures are coming down rapidly. If you are hearing about inflation being sticky or people talking about that, when it comes to the economy, a big portion of that is in the services area. So if you're looking at, when we're looking at economic data, it is a delay when we see the numbers. So actually what we want to look at here to show how things are slowing, if we're looking at rents and shelter, which is a large portion of that CPI, we want to look at real-time data. So the chart on the right here is actually Zillow and rent.com, which is more real-time data. And it is showing that, in fact, we are expected to have, we are seeing already a decline in rents and should expect for the rest of the year for that to come down rather dramatically. And on the next slide, it'll actually show you why it is that we talk about shelter and rents, because when it comes to CPI and the weighting, that carries quite a big rate, weighting on CPI of 35%. So we see here in this chart, used vehicle sales prices have come down, energy prices have come down, which again is expected. But the one thing kind of keeping, it has kept CPI higher, more so is that shelter and rents, which we are seeing again in real-time data coming down. And we anticipate by the end of the year that the inflation target is about 3.6%. That is what Raymond James is calling for. And other economists have similar projections for that. Now, 3.6% is still not the Fed's 2% target. So yes, that has come down dramatically. The interest rate increases have worked the way the Fed anticipated, but we do believe the Fed is going to give up some of that target on inflation in the name of growth. Reason for that, if you look at the chart on the right here, historical GDP or normal GDP back in the 1950s was around 4%. We don't have as much wiggle room because normal GDP right now is 1.7, 1.8. So they really have to be careful about, you know, if we want to have a soft landing, they may have to give up some of that Fed target of 2% for inflation in order to make sure that they don't overdo it. And for that reason, Raymond James believes that the Fed will likely be done raising rates after this month on July 26th. And again, if we look at some of these numbers on the economy, like the unemployment rate, currently at 3.7%, it is still relatively low. This is not something you may be hearing about friends losing their jobs or people, you know, in different sectors losing their jobs. And while that is happening, unemployment is rather low and has come down off that high from, again, the beginning of the cycle in 2020. The other thing that is positive is the labor participation rate. While it has come up off those lows from 2020, we still have room. So there's still more people that have not gone back to work yet. So we will likely see that labor participation rate go up as well. The big question, maybe why you tuned into this webinar, is to find out what we think about a recession. Are we or aren't we going to have a recession? And I'm not going to give you a definitive answer on that because we just don't have a crystal ball. So if you tuned into the webinar to find out the answer to this specific question, I apologize. The one thing I can tell you with certainty is that we will have a recession at some point in the cycle, because that is how it has always happened. The economy has a cycle to it, and I can't tell you if it's going to be later this year, early 2024, or maybe a ways off. But here at Pro Planning, we are going to continue to keep an eye on things and look at the economic data and make sure to keep you invested so that no matter when this recession hits, that you'll be prepared. And with that, I am going to turn it over to Hannah to talk specifically about fixed income and equity markets.
Thanks so much, Melissa. So next up, as Melissa mentioned, we wanted to discuss the fixed income market and just some of the patterns that we've seen so far this year, as well as our expectations moving forward. Again, we don't have a crystal ball, but we can give you some patterns that we've seen historically, and hopefully some of those will ease your mind here. So we can see here on this chart, yields on the 10-year treasuries over the past few years. Many investors right now are really excited about current treasury yields for good reason. However, we believe that kind of the recent shift towards higher interest rates will be somewhat temporary in nature. We are estimating that the 10-year treasury yield, which is near about 4% today, will drop to around 3.25% by the end of the year. And we think there's several factors that are kind of contributing to interest rates lowering. The first major factor would be slowed growth. And this may coincide with the potential mild recession that has been forecasted by some. We also think that inflation is dropping, as Melissa talked a little bit about, alongside the Fed starting to end its tightening cycle. So this will likely cause interest rates to slow a little bit. And finally, we expect stronger demand from investors when it comes to the bond market. And this will likely give bond prices a boost, which in return would drive interest rates a little bit lower. So moving on to this next slide here, we wanted to talk a little bit about which sectors of the bond market we're favoring right now based on current market conditions. So our continued focus here remains on quality bonds, treasuries, munis, investment grade bonds. And we continue to focus on these primary sectors of the market just due to the increasing yields we've experienced. And if we look at the chart here on the left, each of these light pink or tan bars represents the 15-year range of interest rates. And the blue diamond within the bars represents the current interest rate in each of the sectors. So you'll notice that each of the sectors is performing towards kind of that upper range over the past 15 years. And with the exception of treasuries, each of the sectors are yielding north of 5%, with emerging markets yielding around 7.5%. So the other reason we're liking quality bonds is due to their return potential. So each of these sectors did, as we all know and felt, struggled in 2022 and ended the year in negative territory. And we have seen a small rebound so far in 2023, and we don't believe that the bounce back is done quite yet. We think that going forward, these bonds will tend to reap some of the benefits of the Fed starting to kind of end its tightening cycle. And historically, we've seen above average performance in the 12 months following that final interest rate hike by the Fed. So this is demonstrated in the chart on the right, with the dark blue showing performance in 2022, the light blue showing performance in 2023 year to date, and then the gray bar showing the average performance 1 year after the Fed's final rate hike. So we'll move on to the next slide here. And one question we have been asked quite frequently lately is, why can't I just own short-term treasury bills rather than longer duration bonds, since the short-term yields are higher? And we would give two primary reasons for remaining well diversified across the fixed income sector when it comes to the duration of the bonds in your portfolio particularly. And the first reason is related to what's called reinvestment risk. And reinvestment risk, just put really simply, is the possibility that an investor would be unable to reinvest earnings received from an investment at a rate that's comparable to their current rate of return. So this could be potentially true when it comes to short-term bonds in the near term. The strong yields investors can receive on T-bills likely will not last forever. And for example, if we were to look at a year or two down the road, we could see T-bill yields drop from about 5.4% where they are today to around 4% or maybe even a little bit lower. Meanwhile, the longer term bonds, you're getting interest payments for a longer period of time, and you also have the potential for those bonds to increase in value if interest rates were to fall. And the second reason is related to the potential for capital appreciation. So if we look at the chart on the right, we can see what happened if you invested at the greatest inversion of the yield curve. And in simplified terms, inversion of the yield curve just means that short-term rates are higher than long-term rates. And we can see here that around the 6-month out mark, the longer-term bonds are tending to outperform the shorter-term bonds, and this is due to capital appreciation. So if we move on here, we wanted to talk a little bit about the equity market as well, as that's been a pretty exciting place to be so far this year. Year to date for 2023, the equity market has largely been boosted by the tech sector. As many of us know, the tech sector is up by about 43% so far this year. And one of the main reasons we've seen the tech market rally this year is kind of due to the negative sentiment of equities coming off of last year, which is totally understandable. But the number of investors that kind of anticipated positive returns on the equity market going into this year were actually near all-time lows, right around 20%. And this has been the first time since about 2000 that analysts were anticipating that the S&P would be down going into this year. So many investors kind of felt all the pressures of the risks we experienced last year and anticipated a similar outcome into 2023. However, a lot of these risks were already actually priced into the market going into 2023, and risk outlook has really improved so far during the first half of the year. So this really resulted in more favorable outcomes than many investors were expecting. And we won't get too far into the weeds here, but a company's price to earning multiples have increased and the market has improved alongside of that. So as a quick reminder, the price to earnings ratio, or the P/E ratio, is for valuing a company basically to measure its current stock price relative to its per share earnings. And so this has been really good news for market conditions so far this year, but many analysts believe that we will not be able to count on kind of that PE expansion alone to carry the equity markets forward, that we would also need to see increase in company earnings throughout the rest of this year as well. So bottom line here, is that the end of the Fed's tightening cycle will likely provide a tailwind for overall equity markets, and defensive sectors like healthcare, energy, may be the sectors that end up closing the gap for the remainder of 2023. Okay, so we mentioned company earnings on the prior slide, and we wanted to talk a little bit more about that. We can see in this chart on the left that earnings have kind of started to stabilize and even move in a positive direction slowly. And we think this is a result of just the flexibility and resilience in American businesses. And company margins are also remaining well above their historic averages. The way many companies are preserving these margins is through cost-cutting measures, such as layoffs, things like that, which I'm sure many of you have heard about this year so far. And we anticipate that we will probably see this trend continue throughout the remainder of this quarter. So next up, we wanted to talk a little bit about growth versus value in the equity markets. And to give you just a little refresher on the difference between growth and value stocks, companies that are deemed value-driven are those that are considered to be trading below what they're actually worth. So the thought process is that they'll provide a superior return with that growth potential. A growth company is considered to have the potential to outperform overall market over time because of their future growth potential. So we recommend owning both value and growth in your portfolio. In 2022 versus 2023 performance, comparing these two sectors is exactly why we would recommend remaining diversified. We saw value kind of persevere through 2022 with much less of a drop than the overall market in its growth counterpart. However, if we look at 2023 growth so far, growth has been a real driving factor of overall market returns. So again, much of this is related to the tech industry, which of course falls into that growth sector space. And Pearl has made an effort over the past year to kind of balance out our exposure to growth and value within our clients' portfolios. And we continue to maintain this perspective moving into the second half of 2023. Okay, so when will this bull market end? Many investors are starting to feel concerned potentially that we might be nearing the end of this current bull market cycle after the rally that we've seen so far in 2023. However, if we look at historic trends throughout the years, the average bull market usually lasts around 6 years. So we believe that with the Fed ending its tightening cycle and earnings remaining resilient, that we should be able to maintain a strong equity market for the time being. There's also a record amount of cash kind of on the sidelines of the market currently, and this will also help with continued market growth over the remainder of the year. So at this point in the year, we believe the S&P 500 is fairly valued at its current level, but also has the opportunity to move higher over the course of the next 12 months as well. So with that, I will pass it back over to Melissa Joy, and she will discuss how we should invest from here.
Thank you, Hannah. Just to start, I know it sounds like a cop-out. I actually wrote in our upcoming investment newsletter about how easy it seems and how difficult it is to say that we don't predict what's going to happen next in the market. Because having a concrete forecast can really feel comforting to investors, and also kind of acknowledging pessimism and, in fact, providing comfort and encouraging pessimism can also feel very good to investors who who feel the uncertainty that is always present when it comes to investing. What we do instead of predicting is we talk about probabilities, we talk about history, and I think that this chart this list of returns is quite profound and quite interesting given the times that we're at. So year to date, we had through June 30th a very strong start to the year. The S&P up almost 16%. And in fact, in July, so far this month, that upward trend has continued. And you might think, well, take what you can get and get out of Dodge because you've gotten these great returns. But when you look forward, especially at the beginning of a bull market, when you have such a strong time period, it's not assured that you will have positive returns, but most of the time, typically, more times than not, and more times than the average year, you have positive returns over the next 3, 6, and 12 months. 68% of the time over the next 3 months, 82% of the time over the next 6 months, and 77% of the time over the next 12 months. And short-term return periods are kind of a coin toss when it comes to how the market's going to do. So this is really interesting information. And I think it's relevant. Like, it's not a prediction, but again, if you look at history, this is what typically tends to happen. So take note. But for us, you've had a really strong, beginning to the year, and we are business as usual. When it comes to our investment process, we like to maintain balanced portfolios that have exposure not just to the S&P, that have exposure to smaller companies, exposure overseas, and typically also exposure to bonds. So this is just a look in the light blue at how you perform when you have that mix of stocks and bonds, and not just all of your eggs in one particular basket like the S&P. Some have said that diversification always means you have to say you're sorry because there's something that tends to underperform. But also over longer periods of time, I think it increases your batting average because your potential for staying invested remains strong. In a year like this one, where, as Hannah was describing, growth has dominated value, we'll be rebalancing over the next few months, and we'll also be doing the same adjustments that Hannah was discussing about moving from shorter term bonds to what we call in our geek terms longer duration. So medium term bonds, or bonds that don't mature in the next 6 to 12 months. These are just natural parts of that process of having a balanced portfolio, and what we would suggest for you as well. So we're getting to this section that is age old and we always like to remind you of. And this is one of my favorite illustrations of the life of investor, the emoji's guide to investing. Um, i- Over short and long periods of time, investors can have a lot of emotions. And we used to talk about the fear and greed cycle before emojis were invented and, just say some descriptive terms, but I think the emojis say it all. If we were in October last year, you can look at that lower level, the puke face, the angry face, the praying hands, and say, yeah, that felt about right. It just felt very pessimistic. And over the next 9 months, really for much of that time, there was skepticism and a lack of kind of buy-in. But we're seeing in numbers for sentiment and perspective a lot more kind of happy faces, perhaps greedy faces, like, let me in on this action right now. And what we like to do is counterbalance and remind ourselves and each other and our clients that the stone face emoji that doesn't give away the emotions is often the best, most successful investor. So what we'll be doing now is rebalancing, focusing on our investment process and focusing on the things that can drive results, tax aware investment returns. So take this moment to assess yourself. What's your emoji and what has been your emoji over the last period of time? Because sometimes recognizing those emotions, recognizing those triggers that could push you to make a change in the way you invest is really helpful, especially at higher periods of time, because you have the opportunity to have a little more rational perspective, and try to avoid those depths and those highs, the fear and the greed, and keep yourself in the middle in order to manage your investment success. So moving on, um, it's a natural proclivity for people to feel pessimistic. In fact, you could have a very sunny day, and if you were a watcher of markets, if you had CNBC on where they're selling, kind of commercial time and fear and greed keeps the eyes glued to the screen, you could really be feeling about worst case scenario, regardless of how sunny things are. Bad news is good news, or good news is bad news, and bad news is bad news, and that can really hype your emotions, especially in a very attention deplete world. So remind yourself that it never seems like a good time to invest when the market has just gone up 15%, then you missed it, and when the market is down 15%, it sure as heck doesn't feel good to get in. So what we rely on is an investment process that is long term, over time. It's not gambling. It's longer term. I had to explain to my kid recently, my teenager, that investing wasn't gambling when you had a long term game plan. But I hopefully some of these numbers I need to show to him in a moment so that he can understand better. Um, and remember, there's always going to be a reason to sell. This is a chart that goes back to the 1990s. Many of these kind of notes I lived through, thinking about the, questions when Hurricane Katrina and Rita had shut down, a huge part of our country, thinking about the Lehman Brothers crash, thinking about the flash crash, thinking about we haven't even added in the debt ceiling. Um, more recently because there's not room on that right side of the chart, but there is always a reason to sell. And in spite of all that, when you look back over this time period, annualized return, while we don't predict the future returns in this past historical long-term time period, the annualized return of the S&P, even with a lost decade in the middle of it, was 10% annualized. So there's always a reason to feel pessimistic and feel negative, and certainly there are shorter periods of time where investing does not result in growth of your accounts. But over a longer periods of time, it seems to typically come through. And the statistics back that up. This is through 72 years, looking at 1, 5, 10, and 20-year rolling returns in both green stocks and blue bonds. And over shorter periods of time, you certainly can have negative returns. But over longer periods of time, those returns compress and tend to be positive, and in fact are positive over all 20-year rolling return options for this 70-year, 7-decade length of time. We have numbers going even further back to 1871, that show returns of the market as studied by Morgan Housel, where 100% of the time in 20 and 30-year periods, you have positive results when investing. So, again, this is just reminders that are age old and very critical for you to remember about how to think as a long-term investor. Coupled with that investing advice, I think there's emerging research. And in this case, I took a Schwab study and a Fidelity study that both show that coupled with that investing process and investing discipline, having a financial plan can increase your confidence for you being able to achieve your goals. 65% of people do not have a financial plan per Schwab. But when you do have a financial plan, there's market and measurable differences in terms of the confidence that people feel about achieving their financial goals. For that 35%, 92% feel confident that they will be able to reach their financial goals. When it comes to the percentage of investors that feel confident about reaching goals specifically, if you compare with and without advice, you see the differences in those measurements. And I think it's important to think about that as well, because there's so much research on investing, because investing has been around for longer. And the profession of financial planning really was emerging even in the 90s, because the financial planners really kind of came together and distinguished themselves from marketers and investors in the 70s and 80s. So it's a younger profession. But it's encouraging to see that the process of bringing your life's needs to your money and kind of meeting them in the middle and integrating them really does provide quality results for investors. And I'm just pleased to share these surveys. And of course, we are biased proponents of financial planning. How do we go from here? First of all, if you didn't hear my advertisement, have a financial plan. Second, manage your emotions. And since we've had these optimistic results, in spite of what you may have been feeling along the way, it's time to rebalance. It's time to look through things. If your growth stocks were up 45%, as both tech stocks and the NASDAQ are year to date, you may, if your investment has grown that much, you may need to pull a little bit away from there and reallocate to value, to smaller companies, to international. When it comes to the fixed income side, it should be a little bit lower if you weren't rebalancing during the year. So it's time to look at the percentages of your targets longer term and reset them back together. And it also may be time to move from some of those shorter term assets that are popping in yield, like money markets and treasuries, and move T-bills, I should say, the shorter term treasuries, and move the duration for your bonds out. So these are all the shifts that are going under the water. They're not that exciting. They're sticking with the process. There's no, kind of magic bean that you need to buy. It's more about or an iterative process of continuing to rebalance, continuing to make adjustments, continuing to keep your focus longer, knowing that you can't predict the short term. One of the things, though, that is emerging that we see kind of a two-class system when it comes to even very high net worth, very sophisticated investors, is there's not always tax-aware investing occurring in people's taxable or brokerage accounts. So sometimes there's a lack of sophistication. Sometimes they're just working with investment managers who measure themselves on the returns on the statement and not the taxes that you have to pay in order to get those returns. So I would tell you, especially for those of you who have more money that's inside of your retirement accounts, that you need to be thinking, and there are opportunities to become more tax aware. That's an ongoing conversation that I'm always surprised we have so much of, but I'm also pleased when we're able to have those discussions, because we really feel like we're able to bring value to the conversation. So being tax aware is always, I think, an increasing part of our focus and practice, and there's still room for more of that. Be thinking selectively if you have a major change in terms of your income about Roth conversions. This is especially effective for younger retirees. And then when you do have cash that's not your investment, but more of your emergency reserves, you can get really nice yield and high yield savings accounts versus the banks are typically not paying. any yield with your regular checking or savings account. So those are some of the things on our mind. And for many of our clients, there's more specific details. It just depends on your personalized plan. So these are general observations, and we always welcome conversations with you for the more specifics. Um, we do have a Q&A available. So if any of our current listeners, live listeners, have questions, we would welcome them. Just pop them into that Q&A and we'll be happy to answer them. I'm going to throw up my disclosures here. Many of you listen to these as a recording. So first of all, if you're listening or you hopped in later, please know we would welcome you to send us an email with follow-ups if you're in the recording, or re-listen. It'll be on our YouTube channel in a few days. It will also be in our newsletter available for you to check out. One of the things that I'm paying attention to when it comes to the next few months is, with those earnings surprises that are higher, we've already seen so far this year, and we'll have to keep an eye out and see if they continue. But Hannah mentioned the earnings surprises. I'm curious to see how the market reacts, because there's kind of, with that pessimistic crowd, which was everybody almost everybody at the beginning of the year, this assumption that, oh, we've kind of gotten ahead of ourselves in terms of what we priced in. But do keep in mind that there's a huge amount of innovation occurring. If you just think of the narrative of artificial intelligence and how it's altering both professional and personal lives just in the last 6 months as it became more mainstream, there's so much going on under the surface. It's complex, it's less easily kind of understood. So there's not only negative news out there, even though the negative news is easy to find early and often. As we continue through this third year in the presidential election cycle, it's like a breath of fresh air to not have to talk about an election. We'll ramp up our politics talk and our, talk about markets and elections for next year. But do take this respite to focus on some of the things that feel important, whether they are shoring up your investments, making them more tax aware, for many people revisiting your estate plan, or making sure you're properly insured. Checking off the boxes one at a time is what we would encourage. And with that, I don't see any questions, but we always encourage them. And here's your ways to reach out to us. Each of us has emails, and on our website, if you go to the contact place, then you could schedule an appointment with any of us here on the call, as well as anyone on our team. And we just thank you for listening and being a part of the conversation. And we'll continue to provide you the information that we think is important for you to make your financial decisions over time. Thanks, and have a great day.